The financial market often functions as a chaotic, friction-heavy machine. The industry engineers this intentional complexity to justify extracting wealth from individual investors. This creates a central paradox in modern finance. Highly paid analysts constructing complex, actively managed portfolios consistently fail to outperform basic, passive market systems. The statistical failure rate is high. Over a 30-year horizon, less than 1% of active fund managers actually beat the market index. In The Simple Path to Wealth, J.L. Collins argues that financial independence relies on absolute mathematical simplicity. We can build a mathematical model for wealth by isolating 4 specific variables: unit economics, index capture, fee elimination, and the Trinity exit algorithm. Sustained wealth generation requires the systematic elimination of friction and the maximization of automated growth. Consumer debt acts as a guaranteed negative compound yield. Every dollar owed at 20% interest destroys your baseline capacity to generate capital. Mike Tyson earned hundreds of millions of dollars. Unchecked lifestyle creep scales infinitely to consume any level of income. Building true financial momentum requires a relentless and systematic focus on destroying the largest barriers to your baseline generation. Consider the logic of opportunity cost using a $20,000 vehicle purchase. The true cost of the car includes the loss of what that capital could have compounded into over time. This chart visualizes the mathematical divide. A depreciating asset plunges towards zero. However, that same $20,000 yielding an 8% compounding return generates $16,000 of pure profit over a single decade. The primary engine of this wealth model is your savings rate. The time it takes to reach retirement is dictated by the percentage of income you retain. Conventional advice suggests a 10% savings rate. Pushing that to an aggressive 50% savings rate alters your time horizon. A 10% savings rate requires roughly 50 years of wage labor. A 50% rate provides a timeline of just 15 to 17 years. Albert Einstein described compound interest as the most powerful force in the universe, a tool available to anyone who optimizes their inputs. Optimizing personal cash flow to create a massive capital surplus is the prerequisite. Without fuel, the compounding engine cannot run. To deploy that capital surplus, you need an automated engine, the broad-based stock market index fund. A total market index tracks roughly 4,000 data points. It operates on a self-cleansing mechanism. Failing companies are purged and replaced by rising innovators. There's a mathematical asymmetry. Downside is capped at 100%, but upside is infinite, pulling the aggregate average higher. This trend line proves the engine. A $12,000 investment in 1975 yielded an 11.9% return through 2015, despite crashes. Collins separates the market into beer and foam. The actual value-generating fundamentals of a business are the beer. Short-term media volatility and panic are just the foam. Historical data proves that betting on individual stocks is mathematically dangerous. The corporate monoliths of the past eventually fade. An index fund automatically captures the rise of modern giants, securing the winners without requiring you to predict them in advance. If the total U.S. market permanently collapses to zero, index funds will no longer matter. At that point, society itself has collapsed. Index funds eliminate the chaotic unpredictability of individual companies. They provide a predictable upward trajectory over a long time horizon. Even a perfect compounding engine can be stalled by financial friction. Standard 1% management fees silently cannibalize wealth. Compound interest operates bidirectionally. A 1% fee extracts the initial capital and the decades of potential growth that capital would have generated. This line graph maps a baseline compounding model. Investing $500 monthly over 30 years at a 7% return yields a $567,000 portfolio. Adding a 1% management fee reveals the devastation. A second curve diverges downward, creating a red gap that destroys a $135,000 of the final portfolio. Total market index funds avoid this extraction, with expense ratios historically hovering around 0.04%. After eliminating fees, the next priority is tax mitigation. This requires a specific staging sequence for your capital allocation. The first move is capturing any employer 401k match. This provides an immediate 100% return on your capital. The second move utilizes the Roth IRA for tax-free compounding, shielding your future gains from IRS extraction. The health savings account operates as a stealth, triple tax-advantaged wealth tool, far exceeding its original design as a medical checking account. The optimal HSA algorithm is precise. Pay current medical expenses out of pocket, allow the HSA capital to compound tax-free, and reimburse yourself decades later using your stored receipts. Executing this staging sequence builds FU money, a capital threshold providing leverage and optionality against toxic work environments long before full retirement. Structural optimization, ruthlessly eliminating fees and strategically mitigating taxes, acts as a protective shield for your capital engine. The final stage is the transition from the wealth accumulation phase into the wealth preservation phase. The Trinity study provides a statistical framework for sustainable capital preservation based on decades of historical market cycles. The study details the mechanics of the 4% rule. It shows a portfolio can sustain a 4% annual withdrawal rate while surviving historical market crashes. To find your threshold for financial independence, multiply annual expenses by 25 for your target portfolio size. Entering preservation requires shifting asset allocation. A ratio of 75% stocks, 20% bonds, and 5% cash smooths volatility during a crash. The exit algorithm must account for required minimum distributions. At age 72, the IRS forces taxable withdrawals from your retirement accounts. Strategic early planning neutralizes this hazard. Executing partial Roth conversions during lower infra years clears the capital before the RMDs take effect. As the book outlines, a properly structured, self-sustaining financial system provides permanent, unshakable peace of mind for the rest of your life. Reaching this mathematical threshold provides the absolute right to walk away from wage labor and reclaim your time permanently. Capital accumulation principles are consistent. Save aggressively, avoid debt, and let compound interest operate uninterrupted.